So that's where things seem to be right now for the markets at this run-up. The idea that the inflation part of this could be moderating. Now, that might be a leap of faith. Let's go to Scott Martin on that, Jonathan Honig on that. Jonathan, what do you think? This hope, I guess, on the part of many in the markets that we're through the worst of it. That could change, often does, but what do you think?
Well, Neil, and keep in mind the destruction has been monumental. You know, this has been the second biggest loss of capital, of wealth since the global financial crisis. So already there's been tremendous damage done even before the Fed started hiking. What seems to be the case this time is that the Fed's talking about hiking rates. Meanwhile, interest rates are coming down. Now, either that means, Neil, that the economy is slowing or that inflation is slowing. But as you said, I mean, interest rates are down anywhere from 6% to 12% on the long end in just the last month. So the Fed looks like they're wrong to me. And what I'm seeing is a tremendously slowing economy. Despite today's gain, most stocks are still below their 200-day moving average, and I'm a bear.
Interesting. You know, Scott, I like to put, a lot of people who have money on the line, and this MasterCard would be among them. And MasterCard out with a statement says that it sees inflation peaking, but that it's going to remain above pre-COVID levels well into 2023. In their case, it's something that their whole business depends on. And they're saying it's kind of like the quasi best of both worlds. It's still out there, not as out there as we feared for next year. What do you think?
Yeah. Aren't semantics funny, Neil? Because if you look back to pre-COVID days, inflation was nowhere to be found. In fact, the Fed talked many, many years about trying to fight deflation and get inflation off of zero effectively. I mean, we couldn't find inflation even if we tried to create it. So to say it goes back to not pre-COVID levels is a heck of a statement. But to that point of yours, maybe we get to another plateau here in the sense of maybe inflation levels off here at, say, 6% longer term, which wouldn't be awful. And I think Jonathan's point is exactly prescient. Jonathan, you clearly stole my notes that I sent to everybody ahead of the show here, because rates are coming down, guys. Like, inflation's getting worse. More rate hikes are happening from the Fed, yet the open market interest rates on the 30-year, the 10-year, the 5-year, the 2-year, I could go on and on. They're dropping because the market knows the Fed is closer to the end than the beginning. Inflation is closer to the end than the beginning, and therefore eventually things will settle down.
You know, Jonathan, when I spoke to Ken Fisher last week, one of the things he said is there's never sort of like a screaming blue light special or green light special, now's the time to buy. But we might look back at this period and say this was the turning point. He's not saying that from a bullish perspective. He's just saying that there are signals, and these are among them. What do you make of that?
Well, Ken didn't become a billionaire by having a short-term focus, Neil. I think that's especially important to remember. And given now, look, the headlines are very bad. Inflation, regulation, likely more taxes even coming down the pike, whether it's carbon taxes or whatnot. But investors who have had that long-term focus have always been money over time. Where I'm putting my money, however, is not those old favorites, not the Google, not the Amazon, not the tech names, but some of the off-the-radar stream names. I mean, if this is like anything like the period, Neil, of the 1970s or the early aughts, the money's going to be made in value stocks, dividend stocks, and international stocks, not the tech favorites that have led the market for so long.
So, Scott, I'm going to flip that around with what Elon Musk has been saying about the Federal Reserve, among other things, saying that they're overdoing it, they're going to amplify the recession. I think by extension, I don't want to put words in his mouth, that they've already hiked too much. What do you make of that?
I think he's right. I think the market's telling him that. I think both, bond rates and stock market returns are telling him that, Neil. And that's kind of the funny thing to say nowadays, isn't it? I mean, if you want to get on TV, I say that tongue in cheek. You just call for a recession if you're a CEO or if you're a money manager, and that suddenly is news. When in reality, I think the Fed is going to get the message sooner than later. They could over-tighten too, Neil, but my prediction is the more they over-tighten, the more they're going to loosen next year. So great. Maybe they tighten 3 more hikes. Maybe we go into February and March and forward from there. But they'll start loosening just as fast as they tighten if the economy suffers. And that's something that stocks will look forward to. And by the way, preempt as far as rally ahead of that move, because that's what stocks do. They rally ahead of the recovery. They rally ahead of the rate cuts, just like they did on the downside here.
You know, Jonathan, the New York Fed has a survey out. I don't know what to trust and who to trust here. But this is one that looks at consumers and how they're feeling about things. And apparently a good many consumers see inflation easing, and not just a little, a lot. Now, they could be wrong. I mean, oftentimes that is the case. But the markets seem to be seizing on that. Well, if consumers feel that things will calm down, and they're confident of that, then it will have a spillover effect, improve their mood, improve the environment. What do you think?
Well, Neil, that's a real surprise, and it's a turnaround because that consumer confidence has been pinning the lows for really, most of the year.
Exactly.
So, yeah. It's definitely a good sign. And interestingly, a lot of the consumer-oriented stocks, Campbell's Soup comes to mind, have been doing quite well right now. I mean, what's interesting is that, Neil, whether it's through shrinkflation or just consumers tapping into credit, they haven't really slowed down that spending. They've been willing to dip further and further into debt. So, I mean, it's a good sign, I think, short-term that consumers are a little more confident in spending. What we need is the producers, the Elon Musks of the world, feeling more comfortable about putting money to work, investment capital to work. That's where the new economy and the new jobs will be created. Not consumption, but production.
Got it. Guys, I want to thank you both very, very much.